profit and any sales below the break-even sales limit, it implies that the firm is making a loss. Okay, so that is break-even sales. Now the alternate formula to calculate break-even sales, that is, this formula can be rewritten as BEP sales is equal to total fixed cost divided by PV ratio. Now, what is PV ratio? PV stands for profit volume ratio. So, this definition of contribution per unit into selling price per unit is nothing but the PV formula in the opposite side. So, the profit volume ratio can be calculated like this. PV ratio is the profit volume ratio. It is calculated as contribution by sales. Contribution by sales. So depending upon the formula or the details given in the problem, we will be able to apply the different formula relating to break-even. So now, the difference between the actual sales and the break-even sales refers to margin of safety. Now, margin of safety is that amount of sales that the firm can afford to reduce. Even if the sales reduce in this margin, the firm will still have profit. It will not suffer any loss. So margin of safety can be calculated as actual sales minus break-even sales. It is also calculated as the alternate formula will be profit by PV ratio. So, the uses or utility of this break-even analysis is that a firm can take decisions. A firm can first of all assess at what point of time it will be able to break even. So, when you are planning a new business, break-even analysis is very important for you to know at what point you will be able to meet up all your costs. Over and above that, you can plan your profits, you can plan your sales, you can find out how much you have to sell in order to earn a particular amount of profit. In other words, desired profit can be calculated. What are the desired sales that you need to make can be